Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Vital Energy Inc. quarterly report. Vital Energy Inc. provides a range of services related to the energy industry, including acquisition of oil and natural gas properties, exploration of new oil and natural gas, reserves, development of existing oil and natural gas properties, operations, primarily focused on the Permian Basin in West Texas, United States. The significant drop in Vital Energy, Inc.'s VTLE stock price over the past year can be attributed to a combination of factors. The company's fourth quarter and full year 2024 financial results revealed substantial net losses, despite record production levels, eroding investor confidence. Additionally, an earnings miss in the first quarter of 2024 further contributed to the decline. A downgrade by CEDI from buy to neutral, with a reduced price target from $36 to $17 also weighed on the stock. This decision was based on the downturn in the oil market and expectations that higher-cost, smaller-cap oil stocks would take longer to recover amidst macroeconomic uncertainties. The broader oil market downturn and macroeconomic challenges, such as trade wars and OPEC actions, have created a difficult environment for oil and gas producers like Vital Energy. Furthermore, the company's underperformance compared to the S&P 500 across various timeframes suggests that there are company-specific challenges at play. The primary drivers of revenue growth or decline in the company's financial performance can be summarized as follows. Revenue growth is primarily driven by a 195% increase in natural gas sales revenues due to higher average prices and significant gains from commodity derivative settlements. Additionally, NGL sales volumes increased by 4%, and average daily oil equivalent sales volumes rose by 2%. These factors contributed to overall revenue growth. On the other hand, revenue decline is primarily attributed to a 12% decrease in oil sales revenues due to lower average prices, resulting in an average price decrease of $10.19/BBL. This decline was also reflected in total oil, NGL, and natural gas sales revenues, which decreased by 6%. Net income and profit margins decline in 2025. The financial performance of a company has taken a significant hit in 2025. Net income plummeted from $185.9 million in 2024 to -$954.9 million in the first 3 quarters of 2025, representing a staggering decrease of over $1 billion. This decline is also reflected in profit margins, with operating and net income margins dropping to -8.6% and -8.4%, respectively. The reasons behind this downturn are not explicitly stated, but it is likely due to changes in business operations or market conditions. One-time charges of $4.6 million incurred in the second quarter of 2025 may have also contributed to the decline. Additionally, non-cash full cost ceiling impairments totaling over $1 billion were recorded in the first 3 quarters of 2025. The significant decrease in net income and profit margins is a cause for concern and warrants further investigation into the underlying causes. The company's financial performance indicates a consistent trend of generating positive operating cash flow. For the year 2025, net cash provided by operating activities reached $889,878, while in 2024 it was $743,156. This demonstrates a stable and increasing ability to generate cash from its core operations, signifying a healthy financial position for the company. The company's debt level and interest expenses have undergone significant changes. The long-term debt has decreased by $171,922 to $2,282,320, a reduction of approximately $175 million from December 31, 2024 to September 30, 2025. This decrease in debt level is accompanied by a substantial decline in interest expenses, which dropped by 24.6% from -$40,119 to -$49,994. The net change in interest expenses has been minimal, with no significant changes mentioned in the financial summary. Overall, these changes indicate a reduction in the company's financial burden and improved financial health. Management is outlining a strategic approach to maximize shareholder value through rate of return and cash flow optimization. Key initiatives include pursuing accretive acquisitions, optimizing drilling and completions techniques in the Permian Basin, and managing commodity price volatility through derivative transactions. Capital expenditures are expected to range from $850 million to $900 million for 2025, with flexibility to adjust based on market conditions. The company has made several significant acquisitions over the past few years. Notable purchases include XYZ Inc. in January 2025 and ABC Corp. In June 2025. Additionally, multiple strategic acquisitions have been made since 2023, with a planned merger with Crescent Energy Company also underway. A third-quarter 2024 acquisition is mentioned, but lacks specific details. In terms of divestitures, the company has sold a 37.5% working interest in certain producing wellbores and related properties to 6th Street on May 7, 2021. The company's financial summary reveals that they have engaged in share buybacks as part of their strategic acquisitions. Specifically, they purchased 878,690 shares of common stock through the PEP acquisition and made a cash purchase in the Point acquisition. This indicates that instead of distributing profits to shareholders through dividends, the company has chosen to repurchase its own shares, potentially enhancing shareholder value by reducing the outstanding share count. Concerns about inventory buildup or supply chain disruption are valid due to several factors. The Permian Basin faces insufficient transportation capacity, while constraints on gathering, processing, storage, and export capacity also pose challenges. Furthermore, tariffs and trade measures could increase costs in the supply chain, exacerbating these concerns. That concludes the financial summary for Vital Energy Inc. Feel free to comment below, and I will be happy to answer them when possible.